bit of breaking news on our economy now. The Federal Reserve issuing its latest decision on interest rates as concerns continue to grow for our banking system. We should learn any moment whether the Fed is going to issue another hike. If it does, it will be the 9th hike by the Fed in the last 12 months and coming at a time of turmoil within our banking industry. Our business correspondent, Alexis Christoforous, is joining me now to break it all down, along with Elizabeth Schulze over there at the White House. So, Alexis, we should know soon, right? What is the Fed expected to do?
Yes, we are all monitoring. We're waiting for news to cross the wires right now. This is the Fed's toughest call, really, in years. They have to choose between the lesser of two evils. Will they raise interest rates to continue their fight against inflation, or might they pause those rate hikes in order to have, the banking system calm down? Okay, so we just now have this news crossing, the Fed hiking rates by a 1/4 percentage point, despite the recent turmoil we have been seeing in the banking sector. So again, it seems as though the Federal Reserve deciding here to stay the course, deciding that the biggest threat to this economy, short-term and long-term, is higher inflation. So they're handing us our 9th interest rate hike since last March. And this, again, is an effort to slow the economy. They do that by making borrowing costs more expensive. So the hope is they'll slow the economy enough to bring inflation under control. Remember, heading into this report, we knew that inflation was still hot at 6%. We still have a very strong job market. Consumer spending remains strong. So it seems as though when faced with this decision, the Fed decided that it's best to just stay prudent, stay the course, and raise rates to continue its fight against inflation.
So, Elizabeth, any word from the White House as we get these numbers? It does acknowledge inflation is still too high. So what does this decision mean for the Fed's fight against?
Well, look, Kira, the fact is that we've been talking about inflation being too high for more than a year when the Fed first started raising interest rates aggressively. And the Fed doesn't want to change course at this point, even despite the higher rates, the higher interest rates, being one of the key reasons behind some of the bank failures that we've seen over the past 10 days. These borrowing costs, what they're trying to do here are make it so that Americans, businesses and consumers are spending less money in the economy to try to bring down prices. And ultimately what this statement reaffirms is to say we're going to continue to focus on that even as we're seeing this uncertainty in the banking sector. But it's important to say that we're going to be hearing from Federal Reserve Chair Jerome Powell. He's going to face a lot of questions about exactly how they are going to balance the concerns in the banking sector right now with the risks around inflation. And the White House has said that this is the Fed's #1 job. It knows that inflation is a liability. It knows that Americans are still paying too much. The average household still paying about $400 more every month right now than they were at this time last year because of inflation. And so this is the Fed saying we're staying the course. We're looking at what's happening in the banking industry, but we're not reversing course yet because inflation is so important to us here.
So, Alexis, where are we going to feel the impact of this hike the most, you think?
I think Americans are getting used to the impact now, right? This is the 9th rate hike we've had in less than a year. So you're going to see rates almost immediately rise on things like credit cards, also home loans, auto loans, small business loans, and by default, mortgages could see another tick up. I want to mention they had been actually trending lower lately, which was a relief for the housing market. Here's a real-life example of how you might see this. The average person carries about $5,000 in debt on their credit card. With today's 1/4 point interest rate hike, if you pay the minimum balance every month, just in interest alone, you will pay $8,362. That's about $100 more than you would have paid per month or overall in interest before this Fed rate hike. So again, the hope here for the Fed is that these string of rate hikes will work their way through the economy and get businesses and consumers borrowing money less, which will slow the overall economy and hopefully bring these prices down. I mean, food prices still more than 10% higher than they were this time last year. So clearly the Fed had more work to do. They believe so, which is why we got that rate hike today.
So, Alexis, we are expecting to hear from the Fed chair on these hikes. What are you going to be listening for exactly?
This is a hotly anticipated press conference from Fed Chair Powell. It's the first time we're going to be hearing from him since Signature Bank and Silicon Valley Bank collapsed. So we're going to hear, hopefully from him, the reasoning behind the Fed deciding to raise interest rates, even in the face of these issues we're facing in the banking industry. Because let's face it, the string of interest rate hikes we've gotten from the Fed are part of the reason why our banking system is under so much stress. We also want to understand how many more rate hikes the Fed may be thinking about. In their announcement today, the statement that they released, we can glean from that these hikes are nearing the end, meaning that they meet again in May and then again in June. We could start seeing the Federal Reserve pausing these interest rate hikes in the months to come.
And Elizabeth, President Biden has called on Congress to impose tougher penalties for senior bank executives whose actions contributed to the failure of SVB and Signature Bank. So what is he hoping to accomplish here?
Well, Kara, the president has said he wants to make it so that those who were in charge at these banks that failed do not get paid or get paid bonuses. They can claw back their salaries. He's basically asking for Congress to expand the FDIC, the government agency that's taken over these banks, to expand the FDIC's authority to punish some of those bank executives. The public message remains we want to focus on how to prevent this from happening in the future, along with the fact that the regulators, officials continue to say that the banking system is resilient. And I do want to point out that in this Fed statement, there is a line specifically saying that the U.S. banking system is sound and resilient. They are trying to send a clear signal that they're monitoring this. They're aware that there are still potential other red flags at other banks, and they want to say we've got an eye on it. But of course, there are questions that potentially could get down to Congress or maybe even calls from the White House. How did the Fed miss this in the first place? And should more be done to strengthen its oversight so that these kind of collapses that we saw in a matter of 48 hours can't happen again?
All right, Alexis, Elizabeth, thank you both so much.
Hi, everyone. George Stephanopoulos here. Thanks for checking out the ABC News YouTube channel. If you'd like to get more videos, show highlights, and watch live event coverage, click on the right over here to subscribe to our channel. And don't forget to download the ABC News app for breaking news alerts. Thanks for watching.